Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report. Today we're going to look at the debate over inflation. There's no hotter topic right now than inflation. Prices for fuel and food and various services have gone up quite fast in the last couple of months, and people who are under heavy stress on their disposable income are really struggling with inflation. But there's a debate going on here about how hard we fight inflation and how high we should put up interest rates to fight it off. And the debate is settling down into two different camps, and it's worth working out who are in those camps and why it is they have their views. There's a camp that says we shouldn't put up interest rates too high because it will kill off our export sector, drive up the New Zealand dollar, and obviously be painful for those in business. And really, how much of a problem is inflation anyway, they say? They say we should look through these inflation shocks from overseas and that inflation isn't such a bad thing that we should put up interest rates very high. And then there's another camp that says inflation is a problem. We really want to put up interest rates high to stop inflation from bedding in, because inflation is a bad thing later on down the track. These two camps are broadly split between savers on the one hand, who don't want inflation, and borrowers on the other, who like a little bit of inflation. Let's explain why that's the case. If you're a borrower and you take out a lot of debt right now, and you spend that money right now, and you don't have to pay it back for 10 or 20 years, you want a bit of inflation. Because in 20 years' time, when your wages have risen along with inflation, it's much easier to pay back that debt because it's not, frankly, worth as much. But if you're a saver and you put your money aside for a year or two, or maybe even 10 years, you want to be sure that inflation is low, because when you get that money back in 10 years' time to spend it, you want it to be able to have the same purchasing power, or not much less purchasing power. So it's pretty clear that the inflation debate in New Zealand is split between savers, who want to keep inflation low, and borrowers who'd quite like a little bit of inflation. Now it's worth having a look at how that split has changed over recent years in New Zealand, and how much more important now the borrowers are, who want a little bit of inflation. Let's have a look at this chart, which shows the mortgage debt that we've taken on in the last 5 or 6 years. As you can see here, our mortgage debt has risen from about $70 billion about 4 or 5 years ago to $170 billion now. We've taken on an extra $100 billion in debt collectively as a nation. We've gone around buying each other houses and spending it on flat screen TVs and holidays and the likes. So we have that extra $100 billion in debt. On the other side, here you can see our term deposits and how they've changed over the years. Essentially, we only have about $88 billion in term deposits at the moment in banks, and there are other savings and managed funds and the like. But it's worth having a look at this number. Essentially, the amount of money that is borrowed is twice as much as the amount of money that's saved. And therefore, the ones who have borrowed are the ones who would most like a little bit of inflation. I think this is starting to colour the debate on inflation in New Zealand. The borrowers, who would like a bit of inflation, are outnumbering and out-yelling the savers, who don't want inflation. And this is a factor as we think about where interest rates should go. If you want my point of view, I think we should care a lot more about inflation and what it's going to do to our economy, and particularly to the next generation, who will need to access those savings and access the investment that comes from those savings. I'm Bernard Hickey. That was an economic weather report on the inflation debate from interest.co.nz.